I'm Hans Albrecht. So I'm with Options with Hans. I've got other trading businesses as well, and a lot of history in this industry. 15 years as a pro options market maker, so really learning from the ground up. So options are my thing, volatility is my thing. I traded volatility arbitrage for a good chunk of those years. Really kind of long option strategies, a little bit of short options. Back then, it was just a little bit more leaning towards clients selling tons of options. So, guess what you had to do as market makers? Well, you had to buy all those options. So, you had to get very, very good at understanding where options need to be priced. So, we'll just launch right in here. An options buyer, as you guys know, there's an erosion, right? There's an erosion associated with that. So and that's a big budget, right? You can end up with a book. I remember at times having a budget of, say, $30,000 a day of premium erosion, of theta decay, and you had to make up for that. How did you make up for that? By trading the market, trading, trading, trading. And then later on, I ran a number of option income funds for a decade, up to about 12 of these kinds of income funds, as well as two black swan funds. So very, very deep history. So terrific to be here. Thank you, David, for having me. And I'm excited. I guess we're just going to keep going. There's no back and forth, I guess. Okay, so anyway, really kind of the really kind of good exposure to both sides of the coin in the option space, and I think that's really important because I find that people can struggle with one or the other, or really both, and and they're very different games, right? When you're long options, you're long leverage. You're able to turn a dollar into $5. Whereas in the income game, you're going to receive a dollar. It's never going to be any more than a dollar unless you do some rolls or something like that. But you're basically getting what you get. And then it's a matter of waiting for time to play out. Time is your friend when you're short options. Time is your foe when you are long options. And because of that, you are going to have a different set of rules, and you have to be very, very aware of volatility. So everything I do revolves around the concept of volatility being that sort of variable that you need to understand very well, because even though economies change and technologies change, and the sort of flavor of the day changes in terms of what we as humans are interested in, what is consistent over time is how we act, our fear, our greed, and everything in between. And so if you understand volatility, you actually understand something that repeats over and over and over again. Whereas AI wasn't around a number of years ago, but now it's here, and that's a reality for us. But the way that we react as investors, as we just saw, we actually had positions in our Leaps Trader program. We were long Palantir turbos and different kinds of positions, leap trades. And we got out when I saw something in the skew that got exuberant, right? There's signs in the options world that you can use. So we rode that up to about 183. It was one of the best trades of the year. So you understand you learn to read the tea leaves, and the better you understand sentiment. And one of the things that we noticed was that upside call skew was blowing out. And there are some free tools out there that allow you to look at things like that. You don't have to be a hedge fund manager with a gigantic budget for tools. So understanding sentiment is just one of those crucial things, because when you're an options trader, whether you're a stock trader, futures trader, options trader, you are a sentiment trader. You're beholden to all those things that we're talking about, fear, greed, and all that stuff. So the better we understand that, the better we're going to be over time. The better we're going to understand how to prevent ourselves from stepping in those big piles of you know what. And that's how I think you should roll in this game. So what do we got here? Let's take a look. Before I ramble on way too much, let's take a look and see if we've got any kinds of questions. We have our chat here. Here's our chat. Okay. Enter your symbols for me. Yes, please. Okay, let's take a look, guys. So So one thing I would say is in keeping with that idea that we are going to really understand, where's my little thing here? There we go. Why is that not working? Sorry, guys, just trying to figure out my think or swim here so I can give you. Oh, that's weird. Well, timing is everything, isn't it? And my little system has crashed here, so I appreciate your patience. Let's figure out what's going on as we use way too much of our CPU. Um, so what's everybody trading these days? You're giving me some interesting things here. You're not trading Palantir or the mag. I mean, the mag, whatever. The mag or where it's at. It's funny. I was just looking at a chart of. I'll show you guys as this loads up. I was looking at a chart of the Russell of the big cap growth stocks, the mag as we know them, versus hmm, value, right? So this is a question: are we entering? We saw a little bit of a bounce in value names lately as growth has come off a little bit. And so the question is, as we had a number of times over the last 8 months, is this a moment for a shift into uh, mag, or sorry, into value, right? Because mag, although it's not that expensive, if you think about it, I mean, some of them are a little bit expensive. Nvidia, to be honest, is cheaper than its 10-year average. If you look at the basic valuation of it, because they just keep doing better and better. And I think they continue to do better. So I'm not worried about NVIDIA. Uh, we have seen semiconductors kind of fracture a little bit lately. So it's no longer a tide that lifts all boats. It is an area where it quite possibly may be a winner take all, right? There's sort of like NVIDIA, Broadcom, which is you without Broadcom, you don't have data centers. Without NVIDIA, you don't have data centers. AMD to some extent as a sort of cheaper alternative to the in the GPU game because as this proliferates around the world, there will be supply constraints, and not everybody's going to want to pay up for the very, very best products out there. And so there's going to be room for another player. AMD is probably that player, but outside of that, there's some memory names that look interesting. But I think we're heading into a world where even the limited performance that we have out there, which is if you think about it, if outside of semiconductors in the AI space, there really isn't much that's been doing very well. We've had just a little bit of a bounce back lately in some other broader themes. And the hope is that interest rates come down and we get a boost to the rest of the economy, right? You bring down rates and suddenly you've got a new reality for a lot of companies that have debt that's rolling over. A great number of Russell, say 2000 stocks have debt that needs to be managed, and that's a new reality for them. Plus, you give them the ability to increase productivity via AI, which may not be great for jobs in the long run, but that is a promise, a potential promise of great things happening in the broader economy. And I think that's one of the things the market is actually, or we've almost got this loaded up again. Nice timing, Hans. Nice timing. Um, that is the sort of idea. I think the economy, the market is anticipating one of the greatest productivity booms that we've ever seen. And I see people saying, it's over, it's over. We're not going to need that much of this stuff. I mean, sure, it might be they're going to overbuild at some point. That's what we do, right? We overbuild. We did it in the late 90s with fiber, and remember Global Crossing. They overdid it with fiber optic, laying fiber everywhere. So we're going to do it at some point. But the thing is, we are so early in the inference part of this AI game that people may not realize that this is literally the first inning, maybe first half of the first inning in terms of how this is going to proliferate throughout the world. And so there's going to be an incredible need for more compute, more storage, more data crunching ability, and this is really our new reality. So now we know that stories don't always equate to what we think the stocks are going to do. That's a reality. But when you have a strong theme like that, it's a nice thing to kind of have in the back of your mind when you're playing these things. So, hopefully we get a little bit of a healthy pullback in tech, but I still see a melt up in this area in the fall. So, all right, let's take a look at these names again. We are cooking. We are cooking. And we don't have much time left, but we are cooking. And I am going to take a look at the chat again. Tesla. Yeah, let's look at Tesla. I mean, Tesla is one of those mags that I think you really can't until it starts to make a move. Now, I think options are starting to get a little bit cheap on it. So if I look out beyond sort of the short term, which is I don't ever really love playing. For sentiment, Terry's asking, what are the best tools for sentiment? Well, I mean, the all-time greatest is really just your VIX, right? So when the VIX is down in sort of the 15 area, VIX 15 may be the new 13, right? I think we are in a new environment that has a lot of uncertainty as compared to, say, the last decade, which was just stimulus, you know, low rates, all that stuff. Now we are in a new world where we have political issues, we have the end of globalization, or at least a softening of globalization. We have debt problems, we have currency issues, we have AI that's going to really throw a lot of the economy for a loop. It's not all going to be good. There are going to be companies that struggle, that had big moats, that are going to struggle. So it's a new reality, and I think that means that 15 is probably the new 13. So anytime you see the VIX down around 15, 16, it's quiet. A lot of people sort of feel like, well, that's a reason for it to kind of run back up again. But if you look at the mode of the VIX, they say it's a mean reverting thing, right? Fear mean reverts. Fear gets too high, fear gets too low, and it reverts back to a more calm level, right? And the mean on the VIX is 20. That just means the average. The average of it is 20. But many of you may not know that the mode is, and if you remember back to statistics class, the mode is where out of a large sample, where do you see the most of one particular number? Where are the numbers clustering? And in the VIX, that happens to be in the 12s. So make no mistake, it definitely can run up and fear levels can return, but its happy place is at low levels. So whenever anyone says, "Oh, the VIX is really, really low," that means we're about to sell off. Well, no, oftentimes it means the market is just going to kind of continue up. And right now, people are long equity markets and they're very, very hedged. So if you look at skew, which shows you how expensive puts are, it's extremely high, as high as we've seen it in years. And some people may look at that and say, well, that means people are nervous. Look at them buying all these puts. Not necessarily. Part of it could be that. Part of it is most definitely people being long with hedges. And when you're long with hedges, just like you own your house, you have house insurance. You don't lose sleep at night thinking, or when you go on vacation, you're not on edge the entire time because you're thinking, my God, if the house burns down, I'm going to lose $1 million. No, you have insurance. It allows you to function. Insurance allows us to function in many ways. You can drive because if you get in an accident, you're not going to be out a ton of money, right? So insurance allows us to function. And so it's the same in markets. If people are long and quite hedged, it allows them to stay the course and stay long, right? So remember that when you see these skew numbers, it's not necessarily very negative. So so VIX is a really great way to look at it. If the VIX gets above 20, 25, I think there's kind of durable worry out there. So what I would say is, and I tell people, I say, listen, sometimes a VIX 18 is expensive, and sometimes a VIX 25 is cheap. So be very wary of when the VIX gets above 25. It means that there's something eating at the market, right? There's something perhaps durable going on that could continue to cause problems. Whereas every time the VIX, I'd say anything under 20, you can probably fade those kinds of moves. Um, and what I mean by fade is probably buy equities. Although I think these days you're kind of better off maybe buying equities in a much lower risk way. And one of those ways that I do it is, for example, let's take a look at Amazon. I'm going to give you a little freebie from one of my mentoring sessions here. Is that instead of owning Amazon, which 100 shares is going to cost you 22 grand, right? 100 shares of Amazon times 221 is going to cost you 22 grand. So instead of buying 100 shares, what you can do is position yourself out into, let's say, September of next year. You pick maybe about an 80 delta. I kind of like anywhere from sort of a 76 to 84. So let's grab a 78 delta, $51. So one of those is going to cost you 52 bucks, and that's $5,200. So instead of spending $22,000, you can spend one quarter of that to create something that has very similar exposure. You have control of 100 shares, right? It's not going to immediately act like 100 shares as Amazon goes up. It's an 80 delta or 78 delta, but eventually that delta will rise. And so this is a way that you can create upside um, without and also be able to put 75% of your cash in your pocket, right? So you're putting that money aside and saying, well, I don't know, maybe jobs are about to fall off a cliff because of AI, and I'm a little nervous about putting, a lot of risk to work. So you take your $500,000 portfolio and you say, well, I can control $500,000 worth of whatever names you want to be involved in for about a quarter of that, and I can put the other three quarters. It depends, right? Sometimes it's 25% to get into a name. Maybe it might be 30, 35%. So it's going to vary depending on volatility levels and things like that. But I can put a lot of money in my jeans, and just in case something happens and the market pulls back 1,000 points, now I've got some dry powder. I'm going to get hurt on these, but less than if I had owned just Amazon, right? So that's a little bonus we weren't going to talk about today. So let's talk about Tesla. Somebody asked about it, and I'm going to show you. Now, this is a stock, it's a mag that I just cannot totally wrap my head around, right? So I look at Tesla and I say, this is, on the one hand, this is one of the great moonshot stocks of all time, right? I mean, it doesn't get much better than, owning a piece of Elon's mind, right? That's kind of, like him or, love him or hate him. That's really, to me, it's interesting. Google's a moonshot company. There are moonshot companies out there, but this is not a car company. Cars do not matter. This is not trade at a valuation that it trades at because it's a car company. So this is about dreams and hopes for the future. So one thing I like about it is, first of all, I would say you allocate appropriately. Like I would allocate to Nvidia, Amazon, Costco, Netflix. I would allocate to stocks like that without having a single fear. Sure, they can go down, but I'm not worried about these businesses. Tesla, this thing could be $100 one day. Something happens to Elon, maybe it's $100, maybe lower. But if they execute on robotaxi, on the humanoid robots, on a number of other initiatives that they have, this could also be $1,000. So that's what I like about it. It needs to be appropriately sized, but it is a potential moonshot. Now it broke out here, and I started to get a little excited about it. I put on a strangle, and I think that's an interesting way to play it, because if I look at option pricing, this is some of the stuff that we do all the time. I have a couple services. One's called Leaps Trader, and another is called Crypto Income Trader. And so, uh, let me see if I can get this is the kind of stuff we talk about, right? It's about sensible moves using options. And when For example, I'm not doing many sort of covered calls because they give you crap edge. A lot of the time, covered calls, I ran $700 million in covered call funds for a decade, and I generated hundreds of millions of dollars of option income for those things. But I also use them sparingly because the edge is actually negative in the long term as a whole for covered calls. And I know people love them, but sorry to tell you, they're a lot of the time they're crap. And so you use them sparingly. I've been using them lately on Hood. For example, I rode Hood my leaps positions from about 35. I reloaded here when the market came off. I did not sell at the top, but I reloaded a bit. I bought a bit more, and so I rode this thing up. Did I sell any covered calls from 40 to 107? I think it was. No, I didn't sell a single covered call all this way. Actually, I did a couple cash machine trades, I was doing that for students and members in the community to show them how to grab kind of 2 or 3% really, really high probability income per month. So there are those kinds of trades that you can do. And you want to do them on strong stocks, on good stocks. But I did not use them until this thing kind of topped out and I thought the valuation was a little bit on the high side, right? So you want to use them sparingly. You want to be strategic about those kinds of plays because they have poor edge. Um, so with Tesla, I would say you've got I like it. I look at my MTI indicator, which you get in my program. So we had a little bit of green here. It started to get a little bit positive, but we're turning red again, right? So this is basically yellow is a little bit more of an income type environment. Red is be very, very careful. Don't get involved. Maybe, if you own the stock, hedge it more aggressively. And then here you start to get some green shoots, but it didn't last long. So I'd say in here, we're back to kind of a sort of incomey type trade. But with those income trades, what I don't like is that the option prices are again very, very low. So this is a name where I'd much rather be long some out of the money calls. I think we're going to get a melt up this fall, and I think this is a name where you could own like I if I look at something like a Jan 400 for $19, that's cheap. I say that's cheap. And what you could do is you could combine that. You could say, look, I'm going to buy a Jan 400 for $19, but I'm also going to buy a way out of the money put. So I'm going to buy maybe like a 210 for 540. So 19 on the call, and then one of these for about 540. That's going to give you an 8 delta on the put side. And on the upside, you're going to get a nice 33 delta. So you're going to be long 25 deltas overall. So this leans long. This is going to do well if Tesla explodes. Why? Because you're going to get three things. And I want to show you something. I know we're spending a lot of time on one, but I want you to understand where the power in options can be. And nobody teaches this stuff. Nobody. You're going to get just the usual run of the mill, plain vanilla nonsense. That's what happens to everybody before they come to me. I hate to sound like that, but this is exactly what the story I get from all the people who come to me eventually. Let me see here. So what we've got very, very, very cheap longer term implied vols. I would not be selling anything out there. This is where I think strangle, something like that could make some sense. Why? So let's look out. Let's look at a 6 month option, like a 25 delta. So out of the money 25 delta. Look how cheap these are. These are cheap, down around a 54 vol. You can see long-term realized vol. That means actual movement. So pretty cheap. So something like this, you could win three ways on this trade. Number one, and I'm gonna put this trade in here. We'll grab one of those or 10 of those, and then we'll grab. No, we're not going to do 10 because that's way too much money. Okay, let's be realistic about this illustration. This is what it's going to look like. right? So here's your trade. You've got a two-way play. So you can make money to the upside because of the long delta. So you much prefer this thing to go up and rather quickly. You're going to make money three different ways. You're going to make money on your delta because you're long deltas on this trade, and you're going to get longer deltas as it goes up, right? As those 400 calls start to kick in more, you're going to start making money at a more exponential rate, right? This is not linear as we know with options. So you're going to make money to the upside. If it the second way you're going to make money after delta is you're going to make money because this. Here's your cheap option pricing. This is going to explode. If Tesla explodes, implied vol, believe it or not, everyone thinks the VIX goes down when stocks go up. Not always, right? Specifically in specific names, they don't always do that. You're going to make money as the vol explodes, and you're going to make money on skew because skew is cheap right now. I don't have time to look at it, but look how cheap that is. You're going to make money on skew exploding. So three ways to make money when option prices are low like this. Now, what if it completely collapses? If it completely collapses, you're actually going to make money starting at around 230. That's without a vol shock. You haven't even vol shocked it. I think if this collapses on bad news, the vol is going to explode as well. And what that means is we have to vol shock it. I don't have time to do it because we're finishing up, but you're going to actually benefit from an increase in implied volatility, which means this put that you own is going to benefit to varying degrees, but it's going to benefit not only from this delta getting bigger, the negative delta getting bigger, and this delta getting smaller, right? The call gets less important, the put gets more important, but you're going to get a vega bump. That's the benefit from volatility increasing is going to bail you out. So this is what I also call a vega bailout strategy. And it has to be very specific conditions, but I think it's just about there for Tesla. So anyway, folks, I think we don't have a ton of time today. Yeah, David said almost done. So check it out, Options with Hans, optionswithhans.com. We've got a number of different programs there. I'm in the middle of a live mentoring, so I'm not doing a live mentoring right now, but we've got Leaps Trader, which is huge. We've got a few hundred members in there. We've got Crypto Income Trader, which I just launched not long ago, and we are getting going. Oh, thank you, Kevin. You enjoyed it. Thank goodness. I appreciate it.